You could triple the return on your retirement fund when you upgrade to the 1201k plan. Hi, I'm Dave Oakenquist of Dent Research, here with our chief retirement expert, Charles Sizemore. Charles, great to talk to you as always.
Good to be here.
Charles, you're looking a little, is it chilly over there? You're looking a little bundled up. What's going on here? I mean, it's August.
Yeah, I'm in Peru at the moment, and
Oh,
it's a bit chilly in Lima. It's in the low 50s right now, and it's with the humidity rolling in off the water. That's a lot colder than it sounds. But I'm
yeah.
not complaining because it's about 100 degrees back home.
I know exactly. Yeah, it's about 85 here in Florida. 55 just sounds downright miserable. So better you than me. Charles, let's talk about this 1201k plan. Now, I think most people have heard of a 401k plan, but what exactly is a 1201k plan?
Yeah, this started out as actually a joke in the office, and then it sort of morphed into an actual, like a real critique of the retirement industry as we know it today. And then from there, it evolved into a solution. So, the old joke back in 2008, when the market was just melting down, was that, well, my 401k just became a 201k. And, that's good. That's good old fashioned gallows humor. But then I got to thinking, yeah, I mean, you can go from 401k to 201k. Why not just max it out and go to 1201k? Now, obviously, there's no such thing as a 1201k. A 401k is an actual part of the U.S. tax code that
Right.
is named after. Where the play on words here is we think we can get you triple the average yield of a 401k plan. Typical 401k plan these days, you're lucky if you can get 3%. I mean, actually, after the recent decline in bond yields, it's likely much closer to 2. A lot of the 1201k products I've been looking at, we can get you yields upwards of 8, 9, even 10% in some cases.
Yeah. Now, just to that point, I mean, we saw yields rising over the past year. The Fed raised rates, and now that seems to almost be completely out the window. And everyone is sort of racing to the bottom on interest rates, which is going to affect yields across the board, especially for retirement. So, how do you pick out these things, and how exactly does this 1201k thing work?
Well, sure. Let me back up for a second because I mentioned that this kind of evolved into a criticism of the financial planning industry as we know it. One of the biggest issues with financial planning is there are no assumptions on returns. What it boils down to is you go see your financial planner. He says, "Dave, how old are you?" And you give him your age. And he says, "Okay." He puts that into an equation. He says, "Well, you, sir, should be 70% in stocks, 30% in bonds," or whatever the numbers work out to
Right.
for that age. Do you see a problem with that? There's no question whatsoever. Well, what do we think the stock market's going to do over the next couple of years? What do we think the bond market is going to do over the next couple of years? Maybe we shouldn't be in stocks or bonds. Maybe we should be heavy in cash, or maybe we should be, because stocks are cheap, maybe we should be overweighted stocks, or maybe bonds are cheap. Like there's literally no consideration whatsoever for your expected returns. It's based on your age and nothing else. Well, that's utterly ridiculous. I mean, that makes me want to pull my hair out. I mean, that's crazy. So that got me looking. These days, because the economy does look like it's slowing, and because there is a lot of turmoil out there with the trade war with China and what have you, investors are running to treasuries, and it's not just U.S. treasuries; it's all over the world. Investors have run to government bond markets because they perceive it as safe, and it's also not just that; they're also front running. They know that the central banks are going to start gobbling up more government debt than they have already, so they're
Yeah.
getting in front of that trade. That's why you've gotten crazy stuff. Like in Europe right now, I want to say roughly half the bond market is in negative territory, negative yields. Like you're actually having to pay somebody rather than you being paid interest, you're paying them interest. Like they're being paid to take your money, which is insane. But why is that happening? Because if you're a big institutional money manager, you know the European Central Bank is going to be buying these bonds down the road. Even if you're paying interest on them, if it's a negative interest rate, you can still make money on a capital gains play. You have that, then you also just have people who are scared and they'd rather take a known loss than potentially take an unknown loss somewhere else. Well, all that's fine and good, except it's terrible if you're a retiree, if you're or close to retirement, and you're looking to generate income. So that
Yes.
led me. Oh, go
No, sorry, I
ahead.
was gonna say, what if you're talking to your financial planner and you're like, hey, look, I think stocks are really overvalued. I'm not really confident they're gonna keep going up over the next decade or so. And here we are at 0%, maybe negative yields. Is your financial planner look at you and say, well, all right, you're just not gonna retire then, ever. This goes on
No,
forever.
actually, their head will probably pop off. It'll just like shoot off like a rocket ship, and they'll just draw. I mean, they don't know what to do.
Yeah.
No financial planner in business today is ready for this. They've never. This has never happened in the history of the markets. So nobody really knows what to do. I mean, the only it happened in Japan first, but
Right.
that's still fairly recently. Like this, there's no financial planner that studied this in school that really has a playbook for this, because it really is unprecedented. You're going to see more people looking for better alternatives, like I have, but I like to think that we're getting ahead of the queue here. We're getting there first.
Yeah, absolutely. So, all right. So, how do you navigate this environment? And maybe, is this something that people do use? Is this something common? This kind of technique that you've kind of developed?
Sure, sure. Now these 1201ks, got to do the air quote thing. These are traded on the stock market. They are high yield investments. Depending on what they own, they can own corporate bonds, they can own government bonds, they can own dividend paying stocks, they can
Okay.
own any combination of any of this. They can own mortgage investments. What they generally do is they will borrow short term at a very cheap interest rate and then reinvest in higher yielding assets. Now, some of these assets can be somewhat illiquid, which is fine. In this particular structure, the investor, you or me, we have liquidity. We can just sell the investment. It doesn't matter if the investments that the fund itself owns are liquid. So it's actually a really nice way to make illiquid investments liquid, and you get that illiquidity premium, which is really nice. So a lot of these can yield, high single digits. Even some of them could be low double digits. That's an incredible return, an incredible cash yield in this environment. Now they're a little bit more volatile than what you're going to have in the bond market, but that's okay. If you're looking for yield right now, you're just not going to find it in normal places. These give you the opportunity to collect a very nice paycheck, oftentimes monthly, sometimes quarterly, while waiting for the underlying portfolio to move. You don't have to touch your principal. Another issue I have with financial planning is there's no differentiation between capital gains and income. So if the income is a little short that month because there's no dividends or interest, what have you, or not enough, you just sell off part of your portfolio and you live on that. Well, that's great, but it's like a farm with your seed cap. Like if you sell off all of your grain, that you don't keep any for seed, you're not going to have a farm next year,
Right.
right? And so if you might be in retirement for 20 years, and if you start chipping away at your portfolio, you could run out of money. So what I like about this strategy is it's high yield. It doesn't depend on capital gains. I love capital gains. I want more capital gains. But if I don't get them, it's not the end of the world. I can get by on the income alone. And you had asked, what are these things? Do people actually do this? I mean, do real investors do this?
Right.
Bill Gross, Bill Gross was the bond king. He's the guy that founded and ran PIMCO for years. One of probably the most storied bond manager in history. He kept a large chunk of his net worth in these type of investments and still does. By my kind of back of the envelope calculation, I believe he kept about a quarter of his entire net worth in these types of investments.
Oh,
And
wow.
that's a guy that knows what he's doing. I mean, this is the bond king.
Yeah.
Bill Gates, the founder of Microsoft, he also made very heavy investments in these over the past, call it 15 years. So yeah, some heavy hitters are in these. We're not completely out in left field here.
Sounds really exciting, Charles. So, what do I need to get started on this?
To get started with something like this, well, you need a subscription to Peak Income. So got to get that out there.
Okay.
But beyond that, I mean, you can get started with a very modest investment. I mean, literally $100, a couple $100, just very, very small, modest amount in your brokerage account. And you can get started. That's basically it. A brokerage account and a very modest initial investment.
Excellent. If you're interested in tripling the return on your retirement fund and potentially earning an extra $1,200 per month to your nest egg, click below to start now. For Charles Sizemore, I'm Dave Okenquist, and have a great trading day.